Welcome to Talk Tickers. Sometimes the market gives you a real head scratcher, and that's exactly what we're digging into today with FactSet's Q1 earnings. The company posts what looks like a great quarter, but the stock's reaction? Well, it told a completely different and much darker story. Okay, let's just jump right into the big paradox. I mean, look at this. On paper, this is exactly what you want to see. Adjusted earnings per share beat what analysts were expecting by almost 3%. Revenue also came in ahead of the consensus. But by the time the closing bell rang, the stock was down almost 8%. Just a brutal day. So what gives? If the numbers were good, what in the world went wrong? What did investors hear on that earnings call that made them hit the sell button and completely reverse that initial optimism? That's the mystery we're going to solve. And let's be clear, this wasn't just some light profit taking. No way. The trading volume absolutely exploded, hitting 2.6 times its normal level. When you see that kind of volume on a down day, it tells you there's real conviction behind the selling. This wasn't just noise. It was a fundamental shift in thinking. All right, so before we get into what went wrong, we really have to understand what went right. It's super important to see why the quarter itself, just looking at the numbers, looks so strong to begin with. First step, the bottom line. The company delivered adjusted earnings per share of $4.51. That was a clean beat over the Wall Street estimate of around $4.39, a really solid start. And the top line? It looked just as healthy. Revenue was up almost 7% compared to last year, hitting well over $600 million. In this kind of economic environment, that's a really solid growth number for a company of this size. Now, this number here, ASV, this is a big one. Organic annual subscription value. It's the lifeblood of a subscription business, right? It's kind of your crystal ball for future revenue. And seeing it grow at a solid 5.9%, that tells you the core engine of the business is still humming along just fine. And operationally, the whole picture was great. I mean, these are the kinds of metrics that let management sleep well at night. Client retention at 91%, that's sticky. And ASV retention over 95%, that means your existing customers are actually spending more. That's the dream. On top of all that, they bought back nearly $140 million in stock and then re-upped the buyback plan with another $600 million. Everything here just screams healthy business. So you've got this great quarter in your back pocket. You get on the earnings call. What do you talk about? Well, you talk about the one thing everyone wants to hear about right now, artificial intelligence. They really went all in on painting a bullish picture for FactSet in this new AI world. So the CEO comes out and paints this picture of an AI flywheel. The basic idea? He's arguing that all this AI stuff doesn't replace FactSet. It actually makes them more essential. Their high-quality data becomes the fuel that these new AI models need to run. It's a pretty compelling argument. And they didn't just talk theory, they brought receipts. Look at this. User adoption for their new AI products shot up over 45% in just one quarter. From the previous quarter to this one. That is some serious momentum, and it shows their strategy is really starting to catch on with customers. And it wasn't just high-level stuff. They gave real-world examples, like a new AI agent that's already handling a third of their daily support traffic. And they're striking new partnerships to make their data AI native. The message was loud and clear. We're not just experimenting with AI, we're executing on it right now. Okay, let's recap. We have a solid quarter, a fantastic AI story. So why on earth did the stock fall almost 8%? Well, this is where the wheels completely came off the bus. The first little crack in the armor was the full-year guidance. Now, technically they didn't cut guidance, they reaffirmed it. But the midpoint of their range for both revenue and earnings came in just a hair below what analysts were expecting. Is it a huge miss? No. But when the market is on edge, even a tiny crack can look like a canyon. But this was the line that did the real damage. The CFO came right out and warned everyone that Q2 margins are going to get squeezed because of a step up in investment. The market heard two words, spending and margins. And let me tell you, hearing higher spending and lower margins in the same sentence is like poison for a stock in the short term. And you can see the market's mood swing in real time right here. The stock popped over 2% in the pre-market as the computers and algorithms just reacted to the headline beat. But then the humans, the analysts, they read the transcript, they heard the CFO's warning about margins, and boom. The selling started, and it just didn't let up all day. So where does that leave us? Let's put on our analyst hats for a second and talk about what this all means for FactSet and what comes next. On the next earnings call, you can bet the focus has completely shifted. The market won't be cheering a small revenue beat. all eyes are going to be glued to that operating margin number. Because of that, we think the stock is probably going to be stuck in the mud for a bit, trading sideways until management can actually prove that all this AI spending is going to pay off with faster growth, not just permanently lower profits. So when you weigh the solid here and now performance against these really big question marks about tomorrow's profitability, we're landing on a market perform rating. The business is fine, but the story for the stock has just gotten a lot more complicated.
And of course, our final crucial point. This is not financial advice.